Hi, everyone. My name is Allie Johnson, and I'll be moderating today's webinar. I'll begin by introducing the Capital Pathways program, introduce myself, and then pass the mic to our guest speaker, Ford Scott. He's a lender relations specialist based out of the Richmond, Virginia, U.S. Small Business Administration District Office. He'll introduce himself and take us through a presentation on SBA loan options. As we go along, please feel free to ask questions using the Q&A function. We'll respond to them at the end of our session. For any questions that we don't get to today in today's session, we're happy to address through our no-cost one-on-one advising services or connect you with some resources that can help. We'll share a recording and slides of this webinar afterwards. So, what is the Capital Pathways program? It's a program funded by the U.S. Treasury SSBCI initiative, sponsored by the Virginia Department of Small Business and Supplier Diversity, and hosted by the Virginia SBDC and George Mason University. We'll start off with a program overview, then go through program eligibility, and finish up with an outline of the services we offer. Capital Pathways is a no-cost, specialized SBDC program that helps small businesses and nonprofits build the systems and habits needed to become capital ready. This matters because businesses and nonprofits that are less prepared can often self-select out or fail their loan or funding applications. These early failures correlate to a lack of adequate capital, and higher cost alternatives don't build long-term capacity. Ultimately, only about half of the loan amounts requested reach small businesses. So to put things in perspective, about 25% of small businesses need access to financing for growth and preserving cash flow. However, only 20 to 30% of those who apply actually get their loans approved. To help address this challenge, Capital Pathways creates a path to financial and legal readiness. Our program offers an immersive, hands-on group experience paired with one-on-one support. Who's eligible, you may ask? Very small businesses and nonprofits at any stage who face challenges accessing traditional financing. The services we provide include a guided self-assessment, legal structure validation, financial skills and tools, loan application readiness, and credit building advising. As I mentioned, we start with a self-assessment that pinpoints your business's key gaps so we can connect you with tailored resources, either through our program or other resources that can help. Under our legal structure validation, our in-house advisors can help you through basic legal questions, and we also partner with a law firm to help with more complex questions related to business registration, trademarks, and contract and agreement reviews. We also offer financial webinars on topics like financial basics, as well as financial statement preparation and QuickBooks training. Our one-on-one tailored support covers business foundations, profitability and pricing, financial forecasting, financing options and readiness, financial statements and tools, and loan readiness and lender preparation. Our loan readiness preparation services include both webinars and one-on-one individualized support. These webinars cover topics such as what lenders look for in loan applications, interactive mock loan interviews, and sample application analyses, and of course, SBA loan options. We also have a partnership with a lender who can provide one-on-one support to those looking for capital. Finally, our credit building advising will help you interpret and review your credit reports as part of building an individualized credit improvement plan to strengthen your credit and help you qualify for better funding terms and options. So if you're interested in getting started, you can reach out through our website at virginiasbdc.org/programs/capital-pathways or contact me directly at capitalpathways@virginiasbdc.org. I'll share those links in the chat for everyone to have. Now that I've done all of that, I'd like to shift over to introductions. As I said before, my name is Allie Johnson. I'm today's moderator, and I serve as the Program and Intake Coordinator for the Capital Pathways program. I have a professional background in economic development, small business support, and access to finance projects, both domestically and internationally. Our session today will consist of a 90-minute presentation, and please do feel free to ask questions throughout using the Q&A function rather. We'll respond to these questions at the end of our session, and any questions that we don't get to, we're happy to address through our no-cost one-on-one advising services or connect you with resources that can help. Again, we'll share a recording and slides of this webinar after the fact. Now, I'd like to pass things over to Ford to introduce himself, tell us a bit about his background, and start the presentation.
Well, thank you, Allie. I'm trying to get my video to work. As Allie said, I am what SBA calls a lender relations specialist. My main function is to assist lenders in understanding our lending programs, because all of the loans we're talking about today are offered through lenders. We do not lend directly, but we do webinars like this for small businesses to let them know about what financing is available, and then to provide guidance on how to prepare for applying for a loan. So you'll see my contact information at the end of the slide deck. If you have any questions, you're welcome to ask them today or reach out to me later. So there is additional information on our website, which you see there's a link here, but we've got a lot of information to cover today. So the first thing that we want to talk about is I just mentioned we do not offer direct lending. We also do not offer grants. You may have some people tell you that SBA offers grants to small businesses. We do not do that. We have very limited grants that we offer to third parties that train small businesses, but we don't, again, provide that directly to small businesses. So we do not have any grants. What we do is we provide a guarantee. So a commercial bank or credit union, or we have some non-bank lenders, they will lend the money to you, and then we provide that lender with a guarantee, which means that if you default, if the borrower defaults, the business, we will reimburse the lender for a portion of their loss. So that encourages lenders to lend to small businesses. That's our inducement to them to provide financing to small businesses. And the guarantee can help the lender offset some of their risk. A lot of lenders are sort of skittish about startups. Insufficient collateral, that's probably the primary reason that most lenders use our programs, because the business doesn't have sufficient collateral to secure the loan. There might be non-standard repayment terms, industries that the lender's not comfortable with. We see with lenders, they're not generally comfortable with things like restaurants, especially startup restaurants, but it'll depend on the lender. But the guarantee helps with that. I did want to cover some ineligible businesses before we get into the three main lending programs we have. So the first one is none of our lending programs are available to nonprofits. They're only available to for-profits. We also cannot finance investment properties. So you'll see here, we can't finance properties owned by developers or landlords. We have what are called occupancy requirements, where we require the business to occupy a certain minimum percentage of the building. I don't know if I have that in the slide deck, but I'll just briefly mention that's 51% if you're buying an existing building, and then 60% if you're going to construct a new building. But if you're a landlord, like I said, we get calls frequently from people who want to buy houses, fix them up, and then rent them out. All of that is ineligible. So no apartment buildings, mobile home parks, things like that. We can do nursing homes or assisted living facilities, as long as it's not a room and board situation. As long as you're providing additional health care or medical services, then that would be eligible. Pyramid or multi-level sales distribution plans are ineligible. So the old example of that used to be Amway. I'm not sure I have a current example of that, but those are ineligible. We can't lend to any business that's involved in any activity that's illegal at the federal, state, or local level. So you may know that some states are legalizing marijuana, but on the federal level, it's still illegal. So that would be ineligible for SBA financing. You can't have a business that restricts patronage for any reason other than capacity. So for instance, you can't have a men's only or women's only health club, because we're the federal government and our programs have to be open to everyone. You can't have a business that's owned by, they call them associates, who are currently incarcerated, serving a sentence of imprisonment imposed upon adjudication of guilty, or is under indictment for a felony or any crime involving financial misconduct or a false statement. So there's one question we have now on our application. It'll ask you, did any of those apply? If you say yes, then it means you're ineligible. If you say no, then we just move forward. You also can't have a prior loss to the government. So if the applicant business had a prior loss to the government, the federal government, they would be ineligible for a new SBA loan. If you have a delinquent federal debt as well, the business would also be ineligible. And effective March 1st, SBA changed its policies. So all of our small business borrowers, 100% of the ownership of those businesses have to be either by U.S. citizens or U.S. nationals. Legal permanent residents are no longer eligible under any of our lending programs. So the next 3 slides cover our 3 main lending programs. The first one here, we call it the 7A Loan Program, which is just the federal code that created it. It's our primary lending program. It probably accounts for at least 90% of our total financing that we provide. It can be used for pretty much any legitimate business purpose. So you see there, you can acquire, refinance, or improve real estate and buildings. We talked about owner occupancy, so we're talking about only owner-occupied commercial real estate would be eligible. You can have short or long-term working capital, refinance business debt, purchase and install machinery and equipment. You can buy furniture, fixtures, and supplies. We do finance changes of ownership. In fact, we changed this recently to allow even partial changes of ownership. We can finance franchise operations. It's not your responsibility, but I'll just mention here, SBA has a franchise directory where we list franchises that we have reviewed for, well, a couple of reasons: affiliation, and also whether they violate one of our sort of no industries or types of business. So on that directory, you will see franchises listed that are eligible. They may also list some that are ineligible and let you know that they are ineligible. But again, it's not your responsibility to check that directory. I'm just mentioning it because in order for a franchisee to get financing, the franchise has to be on that directory. Just one example of an ineligible franchise, or 7-Elevens are ineligible under SBA financing. Also things like Hooters, those are all off the table. And you can have multiple purposes. So you can have a loan that finances equipment and real estate and provides working capital, or you could have separate loans. We have some lending programs that specifically focus on lines of credit. The maximum loan amount is $5 million. And I will be sending out to Allie. She will share with you. We have a SBA loan chart which outlines all of our programs. It'll tell you the general parameters, like what is the maximum loan amount, what is the maximum interest rate, different things like that. And she'll send that out to you later. Each application, of course, will be reviewed by the lender based on the circumstances for that particular application. The lender will discuss with you and determine with you what type of SBA loan is best. Again, it's not your job to understand all the ins and outs. You can rely on the lender for that. I will mention for SBA, we have a subset of 7A called SBA Express, which can provide loans, both term loans and lines of credit up to $500,000. But if you are in need of a line of credit, that may be your go-to program that you'll want to look for and talk to the lender about. And the second program here is our 504 program. This has limited uses, so purposes. It can only be used to finance owner-occupied commercial real estate. So we talked about that. And then it can also finance long-term machinery and equipment. That equipment has to have a useful life of at least 10 years. And it's generally equipment that is put in place and stays in place the old example used to be a printing press. I'm not sure what the current example is, but it's not something that doesn't move around. So you can't finance trucks. They call it rolling stock. You can't finance that through this program. But you can do, again, owner-occupied commercial real estate and then long-term equipment. You cannot you cannot use this program for things like working capital or inventory, things like that, but you can combine a 504 with a 7A. And we see that on a regular basis, especially with changes of ownership, where the business will finance the real estate through the 504 program, and then the rest of it, the actual business purchase through the 7A program. So that is an option as long as you're not exceeding our maximum loan size. And this program is generally described as they call it the 50-40-10 program. So the way this works is you have a commercial lender who's going to lend you 50% of the total financing that you need. 40% is provided by SBA through what is called a certified development company. And you'll see the link here on this. You'll have a copy of this PowerPoint after the webinar, and you can click on this link here and it will show you we have 3 certified development companies here in Virginia that they make loans throughout the state. So they all compete with each other. It's your choice who you work with, but they will work with you to walk you through the application and the process. And then the 10, so I said 50-40-10. So 50 from a lender, commercial lender, 40 from us. And then your business is required to come to the table with at least 10%. There are a couple of cases where that would increase by an additional 5%. So if your business is less than 2 years old, it would go up to 15%. And then if it's also what we call a special use building, it would go up an additional 5%. So the most it would be 20%, but generally it sits at 10%. And the benefits to you of this program are that you get a long-term fixed rate loan on the SBA portion of this financing, which is generally going to be much better than what you would be able to get conventionally. I just checked the rates, and they're ranging from, I think, 5.6 up to 5.7. They change every month, but that's what they are right now. So that's generally going to be lower than what you get conventionally. And then you can also finance some out-of-pocket costs through this program. Things like appraisals, different things like that, closing costs. That can be rolled into this total project and paid out over time instead of being paid at closing. The third program here is our microloan program. This is offered through, this works a little different than the 2 programs I already mentioned. SBA actually lends money to micro lenders, and then they turn around and lend money directly to you. The lender is permitted to provide loans up to $50,000. And you'll see you can use it here for working capital, inventory, supplies, furniture and fixtures, machinery and equipment. You can't use it for real estate. We don't allow that under this program. And you also potentially could use it to refinance existing business debt if it improves your cash flow, your business's cash flow. Here in Virginia, I think we have at least 4 micro lenders, and they each have specially designated territories. So we have a couple of holes that are not covered in Virginia. For instance, we don't have a micro lender covering the Richmond area, and we don't have one covering the Hampton Roads area, but we do have one in Stanton that covers that area. We have one in Charlottesville that covers that area, and then down into Southside Virginia, we have one in far Southwest Virginia that also covers a portion of the Northern Virginia area, and then we have a 4th one that covers Prince William County, those sort of areas, Stafford, Spotsylvania. So again, you'll have this link, and if you're interested in this, you can contact one of the micro lenders. So next we're going to talk about how to prepare before you approach a lender. So as Ali said earlier, your preparation is going to have a large you know, it's your whether you get your loan approved or not, it will depend on how well you're prepared. So how you present yourself, your business, and your financial needs is very important to the lender. And the best way to do that is to prepare a written loan proposal or business plan. And lenders will look at that document as evidence that your business has strong management, experience, and a thorough understanding of the marketplace or your competition. And of course, they'll also focus on the relevant financial information that demonstrates your ability to repay the loan, because that's the lender's primary concern. I will send to Allie and she'll send out to you. I have a slide deck that I presented on how to prepare a loan proposal. If you're thinking to yourself, well, what's the difference between a business plan and a loan proposal? A business plan is sort of the overarching document for your whole business, your whole plan for your business operation. A loan proposal is a more streamlined document that is intended to or focuses on actually obtaining financing. So it's going to be more, it's not going to cover the full range of what's in your business plan. But I have given you here a link to our website on how to prepare a business plan. Allie and her group, the Small Business Development Centers, are there to help you with that. So it's your choice which one you prepare. But when you're talking about the things that you should have ready before you approach a lender, we recommend the four things listed here. So how much money you need. I usually say with small business lending, it's not like auto financing or mortgage lending where you go to the lender and you say, how much do I qualify for? I just bought a car last year, and I went to my bank and I said, well, what size loan will you provide to me? It doesn't work that way. Excuse me, with business lending, you are required to come to the table when you're talking to your lender, the dollar figure that you are seeking. So I would not recommend going to the lender and saying, how much can I get? That doesn't go over well with lenders. So you bring to the table how much you're looking for, and then you'll give them a breakdown of how you're going to use the money. So you may, in your conversations with them, because they have experience, they might be able to help you. They might say, well, maybe you don't need this much here. You may need some more over here. They may have their own ideas about that, but at least initially, you need to come to the table with the dollar amount and then a breakdown of how you'll use it. The third bullet here, how you'll repay the loan. Of course, that's of utmost interest to the lender. They want to know how they're going to get their money back. And then the fourth item, what will you do if your business is unable to repay the loan? So that's where they get into looking at collateral. And we'll talk about that in a few minutes. You should discuss that in your information that you provide to the lender. We often are asked whether the lender, because you're applying for a business loan, whether they will look at your personal credit history. And almost every lender that we deal with will pull a copy of the personal credit report for every 20% or more owner of the business. You'll see here, you may already know this, but there are three major credit bureaus: Equifax, Experian, and TransUnion. And we highly recommend that before you start your application process, that you check your credit report, make sure it's accurate, and that there aren't any errors on it. We've heard that, I don't know how long ago I heard this, but that maybe up to a third of credit reports have some sort of error on it. So you can clean that up. This third bullet here, I do this myself. You can get a copy of your personal credit report, a free copy, once per year from each of the three credit bureau agencies. And this website here is the designated site. You may go to some other sites and they want you to pay for it. That's your choice. But again, I do this every year. I get a copy of the report and I check it to make sure, there's no fraud occurring, etc. And what was I going to say? Oh, it won't give you your score. It will not give you the credit score. You may have to pay a few extra dollars for that, but at least it will let you see what is actually on the credit report. If you need help in repairing your credit history, you can contact a local credit counseling service. I don't have it on the slide deck, but the State Corporation Commission has a list of credit counseling services that are registered with the state. Just as part of your due diligence, you want to make sure that any credit counseling service you're dealing with is reputable. And then, in addition to the personal credit report history, some lenders will look at your business credit report history, and they do that through Dun & Bradstreet, Experian, or Equifax. I've given you links here to each of those credit bureaus, and I put this note here. So I believe these links that I have will take you to an area of their websites where you can get free information about what they have on your business if you're an existing business. But then they sort of they push you over to potentially services that they may charge for. So it's your choice whether you pay for those extra services. For instance, I think they give an option to sign up for a monthly monitoring service. That's your choice whether you want to do that or not. But I think just the initial information, you should be able to see what they have on you on your particular business. In terms of what a lender looks for when they're reviewing your business application, we've talked about some of this already, but owners and operators of good character. So the main way they determine that is whether you have been honoring your debts, paying your debts. So that's where they'll look at your personal credit report and or the business credit report. A feasible business plan, so we talked about that. Management expertise and commitment necessary for success. So they're going to look at, of course, your experience. If you happen to decide that you're not going to be the day-to-day manager of that business, you're going to hire someone. In addition to talking about your own experience, you would want to talk about that management team so they understand that management team has the necessary experience. Also, just a note related to that. So let's say you are starting a clothing store, just as an example, and you don't have specific industry experience related to operating a clothing store, but you've run somebody else's business or you've been a manager at someone else's business. You should probably talk about that in your the documentation or when you're meeting with the lender, so they understand that you do have some management experience. It may not be in the specific industry, but that will give some extra weight. It'll be a positive thing that they will look for. Sufficient funds, including the SBA guaranteed loan to operate the business on a sound financial basis. Adequate equity invested in the business. We at the SBA has a couple of situations where we set a minimum equity injection. I already talked about under 504, we set a 10% minimum under that program. Under the 7A program, we set a minimum of 10% for startup businesses. And then depending on the circumstances, if you're buying a business, we may require 10% in those situations. But generally, even though SBA sets those minimums, the lender is going to have their own minimum. So for instance, we might set 10, but the lender may require more than that. It'll just depend on the lender. And I don't believe I have this in a later slide, but I did want to mention here, when we talk about equity, you'll see that the next bullet talks about collateral. So often there's confusion about equity versus collateral. Equity is cash in or some sort of asset. Let's say you're going to start a machining business and you have a piece of equipment, you could inject that and that could count as your equity. But most of the time it's going to be cash that the lender wants to see you inject into the business. Collateral is different. So we get the question sometimes, somebody owns a home and they have equity built up in the home and they say, well, that's going to be my cash injection. That's not an injection, because unless you're going to get a home equity loan or something like that to pull that cash out of your home, and then inject that into the business, that's not going to count as an equity injection. But you could pledge that as collateral. So collateral is something that is taken to secure the loan and then is liquidated if the loan defaults. Equity, An equity injection is cash in, like I said, or an asset injected initially, if you're a startup or maybe you're an existing business and it's for a particular reason, you might have an equity injection there. But those are two separate things that are often confused. I already mentioned you would talk to the lender about what collateral you have to offer. Generally, for a business loan, the lender is going to first look at any business collateral that's available, and then depending on the request, may look at your personally held real estate for collateral. And then the last item here, ability to repay the loan on time from the projected operating cash flow of the business. The reason that's in red is that that's, again, the primary focus of the lender when they're making a business loan. A couple of common questions we get. So do you apply directly through SBA? No. So I mentioned earlier, we do not lend directly, so you're not applying directly through us. You would apply through a lender, and we're going to provide to you later a list of lenders and then another way to contact lenders. So you apply through the lender will outline for you what documentation is needed, and then you give that back to the lender, and then the lender comes to SBA for what is needed, the guarantee, etc. And then what paperwork will you be asked to provide? We're going to cover that next. But each application is different. So, we can't cover everything. There might be some circumstances where something additional might be needed, but this slide deck is pretty substantial in terms of what it covers. Should cover most documents that you would need to provide. So now we're going to get into the documentation. This is SBA's documentation that we require. There isn't a borrower application form. You'll see it SBA form 1919. So you could take a look at that ahead of time if you know you're going to apply for an SBA loan and see what's on there. It's completed by the business and signed by an authorized representative of the business. So each owner of the business does not have to fill out that form. It's just that when we say borrower, we mean the business. The lender will ask you for a personal financial statement from every 20% or more owner of the business and any guarantors if that's separate from the owners. It has to be no older than 120 days when it's submitted to SBA, and it needs to include the assets of the owner and their spouse and minor children. I did give you a link here. SBA has its own form. It's a form 413, personal financial statement. But the lender is permitted to use their own form. But the reason I provided the link is you could click on that and it would give you an idea of what the lender will ask you for, so you could prepare ahead of time. They'll ask about your personal assets and liabilities, and then your income, again, both for you and your spouse on that form. This next item is just an SBA form. So if a lender is going to charge you some sort of non-SBA form that exceeds $2,500, we have an extra form that's required for that. The last bullet here, SBA does require the lender to obtain federal business income tax transcripts. We never ask the lender to obtain your personal income tax transcripts. If you happen to be a sole proprietorship, they will ask for the Schedule C. But the main purpose of that requirement is that we had someone commit fraud years ago, and so this is a way to ensure a couple of things. One, that the business is small, and then the one that's in yellow here, to be sure that what the business submitted to the IRS matches what the business applicant has given to the lender, because that's where the fraud came in years back. So we want to make sure that you're reporting the same thing to the IRS as what you're giving to the lender. You will be asked to provide, if you're an existing business and you've been in operation for at least 3 years, the lender will ask for business financial statements for the last 3 years. If you're a startup, they'll ask for a monthly cash flow projection for at least the first year until you're cash flow positive. And I believe I have a link later for a template for that. But again, the SBDC network can help you if you need help with preparing projections. You'll need to give the lender evidence of all licenses and formation documents required to operate the business. So, for example, business license, articles of incorporation, partnership agreements, etc. I talked about earlier the history of the business, a description and history of the business. So you would need to tell them what type of business you're in, the length of time that it's been under your management, your experience, as I mentioned earlier, either in the industry for the business that's applying or related industry. And then if you have a management team, again, tell them what their experience is. And if the above information is in for the second bullet here is in your business plan, you don't need to write that up again. You could just give them a copy of your business plan. So I mentioned the existing business financial statements. In addition to the last 3 years worth of business financial statements, the lender will ask for an interim statement that's no older than 120 days. So what are we in? We're in March. They won't need that if you're close to the year end, so December, if that's your fiscal year that you run, your business runs on, but they may require that otherwise. And if the historical cash flow does not show sufficient debt service coverage for the loan that you're requesting, plus any other debt that the business has, then the lender will ask for projections to show that repayment ability is possible. I mentioned so here's the link to the template. So for new businesses, I mentioned detailed projections, and then there's a link here, which you'll have when you get the PowerPoint to a template for the projections. An equity injection, again, we discussed this earlier, so you would discuss any cash equity injection you're willing to provide. The lender will discuss what their minimum is. Again, we have our own minimums, but the lender may set their own minimum. If you're an existing business, you'll need a current debt schedule that includes the outstanding debts and the repayment terms of those debts. If your debt includes debt refinancing, so if you're asking the lender to refinance debt, business debt, you would need a copy of the promissory note and a payment schedule showing that the debt has been paid in the last 12 months on time and is currently current. So you're all up to date on your payments. If you're renting space, you'll need a copy of the lease. And just an FYI, in terms of SBA lending, we generally require that your lease be at least equal to the term of the loan. So let's say the lender offers you a 10-year maturity on your loan. The lender would want to see that your lease includes a term plus any options to renew that equals that term, so equals the 10 years. We talked about franchises, so I told you about that directory. Again, that's not your responsibility, but you will be asked to provide by the lender a copy of the franchise agreement, what is called a franchise disclosure document, and any other documents that the franchisor requires you to sign. You'll need to tell the lender about any federal, state, or local citations which could preclude you, the business, from normal business operations. You would need to discuss any liens, judgments, or bankruptcy filings or pending litigation, including divorce proceedings. So a couple of comments on that. In terms of bankruptcies, SBA does not have a hard and fast rule or a full stop if you had a bankruptcy. So what we ask the lender to do is look at your repayment history since the bankruptcy was filed to show that you have reestablished credit. So what I'm getting at is a loan won't be declined immediately just because you have a bankruptcy filing. You would need to explain to the lender what caused the bankruptcy and then show to them that you have a repayment history since then where you are making your payments on time. Also, in terms of divorce proceedings, if you are in the middle of a divorce, you may not want to apply for an SBA loan. And the reason for that is that SBA needs to know what the settlement is. So how the assets are going to be divided between the two parties. Because especially for our larger loans, we look at personally held real estate. And if that is not settled, we wouldn't know what's going to happen or, who owns what. So the best advice is to wait until the divorce proceeding is final. If you're buying equipment, inventory, or other assets, I think I mentioned this before, you would provide a detailed listing of those, including cost quotes. So you would get your own cost quotes for that and include that. Collateral, we talked about that. So you would provide to the lender a detailed listing of all the business and personal assets that you're willing to offer as collateral. If you're buying an existing business, you'll need a copy of the buy-sell agreement. The second item is not for you to worry about. It's just an FYI for you. SBA does require what is called a business valuation, and that is an assessment in order to determine what the value of the business is. And the SBA loan, the reason we do that is the SBA loan cannot be used to finance more than that. We can't, unfortunately, accept a business valuation ordered by you or the seller. It has to be ordered by the lender and delivered to the lender. But again, you're not responsible for that. I'm just letting you know that there will be a cost. Well, there could be a cost. It depends on the details of the loan request, but there could be a cost related to that, and the lender will pass that cost on to you. For the business you're buying, we'll need a pro forma balance sheet, which shows the assets and liabilities, et cetera, for the business as of the transfer date. We'll need the last 3 years worth of the seller's financial statements. So that would be the business that you're going to buy. And then we'll need an interim statement, like I mentioned, that's no older than 120 days. SBA does have this sort of obscure rule related to changes of ownership where we want to see some benefit to the business, not just, maybe the seller's getting a great deal, the buyer's getting a great deal. We want to see some benefit to the business. So an example of that might be the current owner has run the business for 30 years. They want to retire, and if they didn't sell the business, they would shut it down. So that's helping preserve the existence. Another example might be that the current owner of that business has sort of been an absentee owner, and they had a manager in there that wasn't really doing a great job running the business, but you have plans to come in and build that business back up. That would meet our requirements. The lender will talk to you about that again. It's not up to you to just explain to them the reason for the sale. If you're buying real estate, you'll need a copy of the signed purchase agreement. Again, it's not your responsibility, but just an FYI. Depending on the circumstances, there will either be an appraisal cost that you will be asked to pay, and potentially an environmental investigation cost that generally comes up when the property that you're buying has been used for what I believe we call an environmentally sensitive industry, like a dry cleaner or a gas station or something like that. The lender has to go out and order a special kind of report for that, and that cost would be passed on to you. In terms of the loan closing cost, we get this question frequently. So the lender is permitted to charge you for what they call out-of-pocket expenses. I've already mentioned some of this, but filing, recording fees, photocopying, delivery charges, collateral appraisals. I mentioned the environmental investigation reports, etc. Now, what you may want to ask the lenders if they will finance those loan closing costs, and many of them will, so you won't have to pay it out of pocket at closing. And I believe I talked about the business valuation and the appraisal. So again, you can ask the lender if they can finance that. Otherwise, you will have to pay those costs out of pocket. We added this slide a few iterations ago because SBA has a policy that every 20% or more owner of the business that's applying for the SBA loan has to provide what is called a personal guarantee. And then there are some situations where if you own less than 20%, potentially you might be required to personally guarantee. I've given you a link here to SBA's form. Again, the lender's permitted to use their own form, but if you just wanted to read what a personal guarantee is, read about it, you could look at that form. And then I've given you this link here. It's not to an SBA site, it's to Investopedia. So I hope I'm not getting myself in trouble there, but they give a detailed outline of what a personal guarantee is. So now we're on to the 504 program. We're not going to go slide by slide, and you may be thankful for that, like we did for the 7A. But I've given you the link here. If you're applying for a 504 loan, you can click on this link. And then I've outlined here at the bottom the exhibits that you would be asked to provide to the certified development company. So you can look at that. And you can also, like I said, you will be relying on the certified development company to walk you through all that. This is just for your information purposes, so you could potentially prepare before you apply. And then in terms of the microloan program, each microlender will have their own documentation that they require. We don't outline it like we do for the 7A and 504. At a minimum, they'll have an application and then documentation that they need to assess your business operation and your funding amount. But again, they will provide that information to you. We have been asking lenders for their advice on that they would give to small businesses that are preparing to apply for a loan. So we've got a couple of items here. The first one is very important. So I mentioned if you're a startup, you'll definitely need projections. If you're an existing business and your historical business cash flow does not show debt service, then you will also need projections. But the advice that we've received from lenders are to make sure that those projections are realistic and attainable. They will often see, you'll hear a lender use the phrase pie in the sky. They don't want to see that you just sort of pulled those numbers out of the sky, out of the air. They are going to want to see how you arrived at those figures, and they will ask you to outline those, your assumptions. And the SBDCs can help you with that. They're a great place to go for help with that. Many lenders will use industry data, like the Risk Management Association data, to determine if your thing, for instance, your gross and net profit margins and some other financial metrics are in line with industry standards. And you can see here, I've given you a link for some of the terms, what gross and net profit margins mean. But they're looking at that to assess whether your projections are in line with industry averages. The second item they mentioned is the importance of complete applications. So what will happen often is you'll go to the lender, you'll start the application process, you send the information back to the lender, and then the lender says, well, some items are missing, and they will send a list back. Maybe they give you 5 items, and then you send them in piecemeal. So you send in 1 item this week, 3 weeks from now, you send the second item. That's just going to delay your application. And you would think that the lender could move forward if they have just that 1 item out of the 5, but they're not going to do that. They're going to let your application sit there. I mean, they may look at it, but they're not going to move your application forward. So you should have all 5 items together and send them back all at once, and that will cut down on the delays. I mentioned the lender list. So we have our own list that we maintain here in Virginia. Our office covers all of Virginia except Northern Virginia, although we have some lenders that are located in Northern Virginia on the list. So you're welcome to use that list. We normally recommend that you start where you have some sort of bank account already. So that could be personal or business, because that lender may be more willing to lend to you than a lender that doesn't know you. In addition to that list, there is a system called Lender Match, and it's an SBA system. You go to this website. Unfortunately, you do have to have a user ID and password, but that's to protect your PII, or personally identifiable information. So you log in, you provide information about your business and the loan that you need, and then that will get sent to any lender who has signed up for the area where your business is located. Each lender will look at what you've provided, and if they're interested in having a conversation with you, they won't reach out to you. They will opt in. So the way it works is you fill it out, it goes to these lenders, they opt in, and then you'll get a final list of lenders that are interested, and then it's your final decision whether which lenders to speak with. I did want to mention, it's on the slide, one caveat about Lender Match. So every lender that's on Lender Match is an SBA lender. You're not going to get spammed by signing up for this, but what we have seen happen sometimes is there are lenders on here, there are SBA lenders, but they will sometimes refer you over to partners of theirs that provide financing in some way, but those partners are not SBA lenders. So just be careful if you fill this out and you start being, someone contacts you and they're offering things like, a 30% interest rate or, a 6-month maturity, so things like that. You're out of the SBA world because we set maximums on our interest rates and things like that. So just be careful. We're not telling you that you, of course, cannot use those other entities for financing, but once you get outside of the SBA arena, we don't control any of that. So just do your due diligence before you enter into any sort of financing arrangement. I think this is my next to last slide. So one other thing that will potentially be of use to you is we publish on I think it's a weekly basis now, what we call SBA lending reports. Each SBA district office has their own report. And again, our office covers all of Virginia except Northern Virginia. The Northern Virginia area is serviced by the Washington, D.C. SBA district office. But the way these reports can help you, there are a couple of ways. One, it can help identify lenders that are most active, SBA lenders that are most active in a particular territory. So again, our territory. And the other way is it will show you the average dollar size for each lender, and that could help you focus in on lenders that maybe lend in, if you're interested in a smaller dollar size, that could cue you in, or potentially if you're interested in a larger dollar size, but that could help you. We do have several lenders that will make small dollar loans, and that when you look at this link back here, we've noted some of those on that list there. There's my contact information. We can take questions now, or if you have questions later, you could reach out to me.
Thank you, Ford. So it looks like we do have quite a number of questions in the queue. Starting with what additional SBA loan guarantees does the SBA provide to veteran disabled businesses? So I think they're asking about the SDVOSB.
Okay, well that SVOSB, and I'm not the expert on all the acronyms, but that's a certification program, and we're talking about lending. So we don't have specific lending programs just for veterans, but we do have under the SBA Express program, if the business is owned at least 51% by a veteran, that can also include their spouse. It can include National Guard and reservists members. It can include widowed spouses. If they own at least 51% of the business, we will waive. There's an upfront fee that borrowers pay under our 7A lending program, and that will be waived for any veteran-owned business. So that's what we're offering to veteran-owned businesses. If you happen to be in Virginia, I'm not trying to step on Allie's toes in the SBDC, but we do have a separate Veterans Business Outreach Center. It's in Norfolk at ODU. So if you are a veteran, you may want to reach out to them in addition to Allie's network there, and they can provide some assistance to you. Oh, and I can put a link to them in the chat. So Allie, if you want to go on to the next question, I'm gonna look that up.
Yeah, so the next question is actually related, just confirming that you were talking about, or that you're talking about the 7A Advantage loan for this service disabled veteran-owned small business.
Okay, so here's where it gets confusing. We used to have several different designations. We had a separate a lending program just for veterans. It was called Patriot Express. That has been discontinued years ago. And then we used to have, I think we were calling it something like, uh, uh, I forget the exact term, but all of those special programs, they don't exist anymore. So what we're providing is under SBA Express, and again, you'll see that on your chart when Allie sends it out. We're waiving that upfront fee for veteran-owned businesses. That's what we're offering now to veteran-owned businesses.
Thank you.
And I'm going to put in the chat the veterans business. Okay, you can go ahead, Allie.
Yeah, so the next question is related to that franchise eligibility database that you were referencing.
Yeah.
How within that tool, how can you tell if a franchise that's listed is eligible or is ineligible?
Well, most of them will be eligible. In fact, I can actually even pull that up right now and show it to you. There are only going to be a few that are ineligible, and they actually initially were not even listing them on the registry because it was confusing, but I believe they list some of them now, and they actually will tell you that it's not eligible. So I'm pulling it up now, and I'll share my screen. Okay, so you can tell me whether you can see that. So you'll see here the brand name is in column B. So let me see this as an example. Okay, yeah, here. They list 7-Elevens. I told you they were not eligible. Yes. So this is an example of one that's listed that is ineligible, and they told you over here in the notes section that it was only eligible under our pandemic-related loans. So right now it's not eligible at all. But most of the rest of them, if they're listed here, they would be eligible. There are some where they will give you a note over here to the right, but again, it's not your responsibility to worry about this. It's the lenders. Some comments, like here's a 7 Spice Cajun seafood. It says the real estate where the franchise business is located will secure. Anyway, I'm not going to get into all these details, but if you see it on here, unless there's a note that it's not eligible, it means it is eligible. And then if your franchise happens not to be listed, then either the lender or the franchisor will need to submit documentation to SBA so it can be placed on the directory.
Got it. Good to know. Next question is, does the program support two parallel business initiatives with different capital profiles within the same company? And they were looking at slide number 5.
Slide number 5. Okay, so the 7A program. So we don't have any prohibitions on if a business has different lines of business, as long as the lines are eligible. I mentioned things like investment property and some things that were ineligible. But if I don't know, I'm just going to make something up. You got a restaurant on one line, and then I don't know, maybe a brewer, and you're going to sell your brewed beer as another line. I don't know, something like that. I don't see a problem with that. You would just explain that to the lender. If they operate under separate corporations, each one actually could get their own loan as long as you're not near, haven't exceeded our maximums, which will be on the loan chart that you see. But I don't see an issue with that.
Got it. Next question is, what is the criteria for a microloan?
So that's going to be similar to what I outlined. I will tell you that for micro lenders, they will often be more willing to consider, for instance, someone who has maybe a lower credit score. The microloan program is designed to offer technical assistance. So it is for smaller loans. A lot of banks are not interested in smaller loans. So the microlenders understand that it's a mission-based program where they know that some technical support will be needed. Uh, but in terms of just the decision making, it's going to be similar. They'll look at your business financials. They'll ask you for a personal financial statement from the owners. Uh, Repayment ability, of course, is also their main focus, but it's similar to what we covered. Trying to think of what really would be different. It's going to be very similar to what we covered in terms of uh, the decision making and the documentation. I mean, I have to say it may be less potentially under microloan, but I guess it would depend on the lender. I mean, they'll ask you for the same financial information and things like that.
Okay. For a 7A loan, do you need to have previous experience in an industry to buy a business when trying to qualify for a 7A loan?
So this is not even SBA specific. Most lenders, when you're going to buy a business, want to see that either you have the industry experience or you're gonna hire a management team or a manager that has the experience. So I would say if you have no experience, you need to explain to the lender uh, how you're going to overcome that. Uh, Again, I mentioned if maybe you have no ownership experience in that industry, but you manage someone else's business. If you managed a business, that gives you that history of just the expertise of managing a business. Um, but you're going to need to explain to them what what makes you believe that you could operate that business in an industry that you don't have any experience in. So again, either talk about that or talk about if you're going to hire a manager and they have the experience, then you should explain that.
Thank you. Also, for the 7A program, is the small business required to bring a percentage to the loan, different from the 10% on the 504 program?
So I mentioned, and this is where it's probably too many details for you, but so we set a minimum. Allie, did I just lose you?
No, I'm still here.
Okay, sorry. Okay, so we set a minimum of 10% for startups, and we also set a minimum of 10% in some cases where there's a change of ownership, a business acquisition. But again, I mentioned earlier, most of the time the lender will have their own minimum. So you'll need to ask the lender what their minimum is. Um, but for startups and certain changes of ownership, we set it at 10. And but generally, then anything beyond that, the lender will decide what they'll require in terms of an injection, cash injection.
Alrighty. How many SBA 7A loans could someone apply for or have in active?
So you can have many. So again, Allie will send you the chart for the Express program. You can have as many loans as you like, up as long as they don't combine total more than 500,000. When you get into our what we call our standard 7A program, again, you can have multiple loans as long as they don't exceed our maximum of. It actually gets a little more confusing. So we set a maximum guaranteed percentage because I told you we're guaranteeing the loan, and that's 3.75 million. So just as an example I gave earlier, you potentially can have a 504 loan if you're going to buy real estate, and then you get a separate 7A if you're going to buy a business. You could even have a third line of credit under SBA Express, so you can have multiple loans, different types of 7A and 504 loans, as long as you don't exceed our maximums.
Got it. Um, for a microloan, can the microloan be used to pay salaries before the small business starts to receive payments on their invoices?
So if you are a startup, you can ask for financing to cover your, I don't know, first 3 to 6 months while you're uh, launching the business until you start to bring in revenue. Uh, that's a common, especially for startups, that's a common practice where you would include salaries in that period where where you're just starting out.
Can you purchase a business that is failing if you can prove in the business plan how it will be profitable?
So what I would say on that is a couple of things. First, the lender's going to want to know why it failed, and then what you're going to do that's different because if it failed, it's in a particular location, a particular industry, they're going to want to know why your ownership would change that. And then the other challenge is they, as I said, will ask for business financials from that existing business, and those would not show repayment ability because you said it's failing, and so you would need to provide projections on how to overcome it. I have to say, just on a general basis, most lenders are not going to be interested in you buying a business that's failing. Although I will say, if it's just the equipment, well, let's say the business is failing and you're going to get a good price on, any equipment or other assets that are being sold by that business. If it's just the assets, uh, that potentially would be more understood by the lender than just, why would you want to buy a failing business? They may ask themselves. So that's going to be a challenge.
Good to know. What is the turnaround time typically for a loan approval? Would you advise that a business owner wait until they get until they get a contract, or can they apply in advance?
So in terms of the turnaround time, and this again is where some of these things we just don't talk about because it's a burden for you to try to remember all this. But some programs that we have, the lender gets to make the decision on their own. They don't have to come to SBA. They just enter some information in our online system, and then other applications require SBA to provide an approval. So for smaller ones where we're actually providing the approval, if it's a smaller loan, let's say 350 or less, I would say the turnaround would be pretty fast. In fact, I had a lender just the other day. He got a response, I think it was in 1 or 2 days from SBA. For larger loans, over 350 up to the 5 million, I'd say you're looking at least 2 weeks, so 10 business days. And as I mentioned earlier, the turnaround time is going to depend a lot on your back and forth with the lender to make sure that the application is complete. And the second part of the question, in terms of, we see this with government contractors a lot. What happens with that is the lender's going to want to see that you have the contract, but unfortunately, the contracting officer wants to see that you have the financing in place before they will award the contract. So you're sort of in a chicken and egg situation. Uh, it hasn't really been solved all that well. So, I mean, the best case is that you have the contract in hand, and then you go to the lender to request the financing. That would be the best scenario for that.
Similar question related to timing of a loan, but this one within the context of developing a prototype and testing, and the business owner needs to purchase some machinery to make the prototypes. Can they get a loan started, or should they wait to be in business for a few years to show earnings before they apply?
So I can tell you that SBA loans cannot be used to finance research and development. So that's sort of, to me, sort of fits into that. And the other consideration is when you go to the lender, they're going to want to see, and SBA wants to see this, that you are ready to hit the ground running and selling your product uh, pretty fast. I mean, you're ready to do that right away. And if you're still working on the prototype, you would not be able to show that. So it's better to have your product uh, finalized, ready for sale, and then you could go to the lender and apply for the loan. because they're going to want to see that you're ready to sell it now, and that you're not still trying to develop it.
Got it. What is a common pain point that you are seeing happen with potential clients with regards to being prepared to apply? Uh, when it comes to being prepared to apply outside of any credit issues that you're seeing?
I would say, aside from credit, we talked about, especially if you're a startup, an equity injection, because you may have heard the lenders talk about skin in the game. They want to see that the owners of that startup are going to have some sort of cash injection, like I said. So if you don't have that, that potentially could slow you down. Collateral, although I said this earlier, SBA lending programs are designed to, so the 7A program, to accept a shortfall in collateral. We look at repayment ability. Repayment ability is our main focus, whereas in conventional lending, the lender's often very interested in having a fully secured loan. So I'd say collateral. Um, and then just, I would say in general, your experience. Again, if you don't have any experience in the industry that the business is in, that could be a challenge.
Okay. Next question is, will the lender tell the applicant which program they would fall under?
So what you're going to find is, first of all, when you look at the list that we provide, you will see that some lenders are we show there as express lenders. So if you see on that list that a lender, it's over to the right, it'll tell you their designation. So it'll say SBA Express, or what we call our preferred lenders. Um, they especially the preferred lenders, they have their own sort of engine going, where they do this on a regular basis. They know how the SBA process works, so they will just say that this is the best product for you, or best program for you. Uh, they will discuss that with you, and it will depend on the lender in terms of what is available to them to use. So uh, I would just let the lender. I mean, you can always contact several lenders and see what they'll offer. Uh, but the difference between them is often going to be things like, what the interest rate they want to charge, what the minimum equity injection is. So that will differ from each lender. But yeah, I would just let the lender figure that out, and it's just too much for you to spend your time on.
Do banks that are part of the lender match compete with lower rates? I'm guessing either within the lender match or outside of it.
So I would say uh, that's not an SBA specific thing either. So the lenders, all banks know that you can go down the street and get a loan from, potentially some other lender. So the market is going to drive a lot of that. Also, your particular circumstances, your personal credit score, uh, your industry experience, and different things like that will help potentially with being able to have a lower rate. So it based on your circumstances, plus the competition in the marketplace, the lenders know that you have potentially other options. So and also the lender is often limited by their own internal bank policy, so they may not be able to offer you uh, necessarily a lower rate. I mean, the large banks, I won't mention any because we're not permitted to do that really, but they have the ability to offer potentially lower rates than some, maybe a smaller community bank, just because they're limited in terms of where they get their funds from. So
Got it. What is the longest repayment term for a loan? 10 years or more or less?
Okay, so you will also see that on the loan chart that you get. So under the 7A program, we limit working capital to 10 years, inventory, those types of things to 10 years. We also limit changes of ownership to 10 years unless there's real estate involved. For real estate, under the 7A, we allow the lender to go out 25 years. But again, this is where too many details may overload your brain. But so what happens is we allow 25 years under 7A, but we don't allow balloons or demand features as part of a loan, the repayment term. So at least some lenders will say, okay, I don't want to do a 7A loan with a 25-year term if I can't have a balloon. So they will then move over to the 504 program, and we only require the lender on the 504 loan to offer a 10-year maturity there. So you get a 10. I mean, it depends on the lender's circumstances, what they offer you. But let's say the lender sets a 10-year term on their 50%. We give you a 25-year term on our 40%. That's more appetizing, if you will, to the lender than doing a fully amortizing 25-year term under 7A. And then under 7A, we allow terms up to 10 years generally on equipment, although you can go out 15 years if you meet the IRS asset class that allows 15 years. And that pretty much covers it. On the 504, I talked about that. We give a 25-year term for real estate, and then the lender sets their own term. It has to be a minimum of 10.
Good to know. Is there any resource that will show the areas of business that are successful in securing loans? The question asker is interested in an exterior or interior kitchen/kitchen design business, as well as developing a sewing organization accessory product.
Well, the thing that immediately, I mean, if you're talking about SBA lending, the thing that immediately comes to mind is we do have they call it a FOIA, Freedom of Information Act website, where you could actually go and pull data on SBA loans, and you could see, what types of businesses are obtaining SBA loans. But just on a general, easy to access site, I can't think of any right now. It's more well, not in every case, but I would focus more on just getting yourself prepared and showing, your expertise and different things like that than and focusing. I mean, I told you earlier, many lenders are not comfortable with restaurants. Some of them are not comfortable with hotels. It just depends on the lender. Uh, but I don't know. Allie, do you know of a site? I don't know of any site other than, like I said, the FOIA site that SBA has where you can actually find out who's obtaining SBA loans. I don't know about conventional lending. I don't believe I've seen that anywhere.
Yeah, I know there's some of what our advisors do is that market research piece, looking at, what the demand is, but I haven't heard of anything that's looking at like uh, inclination or commonality of businesses getting SBA loans or other types of loans.
Right, right.
Next question is the benefit that you mentioned for veteran-owned businesses. I believe that's that discount.
Yeah, yeah.
Will that reduce the amount that a small business has to pay or has to bring to the table under the 7A program?
Um, I would say no. I mean, that guarantee, they call it a guarantee fee, and that's just an extra fee that the small business pays. So I would say not, not. I mean, it will reduce that because you won't have to pay that, whereas other SBA applicants will have to pay that. But other than that, in terms of those percentages I mentioned, the 10% for startups, et cetera, it won't reduce that.
What are the guidelines for a loan for a startup that later plans to expand into a related business in the same industry after the startup is up and running? So that sounds like a loan that's, for a business that's currently in startup phase but is looking to grow?
Well, it's definitely eligible. The guidelines would be the same. So let's say you start your business, and then I don't know, 6 months to 12 months from now, you decide to expand that. I mean, you can get a loan for the expansion. So there's not a the guidelines that I outlined would be the same in terms of the documentation and what you would need to show to the lender, how to prepare. It's all the same.
Okay. Um, Next question is, the question asker would like to apply for a loan and plans to use what so that they can use what they need when they need it and maybe not use the whole loan. Is that something that they could do through an SBA loan, or would there be a different tool?
Okay, that is an excellent question because we see that frequently, and the answer is no. So let's say you say, uh, today you need, I don't know, 50,000 for to hire a new employee, or to buy some inventory or something, and then you're gonna take 20,000 of that money and just put it in your bank account and have it sitting there just in case, or just, you know, the lender will not want to see that, and SBA would not want to see that either. We want to see that the funds that you're applying for will be used in a fairly short amount of time. So you can ask for working capital, and when you ask a lender for working capital, they're going to want to know or want to see why you need that amount of working capital. So, if you're a startup, you would provide them projections, and then let's say you're asking for you could ask for working capital for 3 to 6 months, and your projections would have to show your shortfall in cash that you need to cover during those first 3 to 6 months. Uh, that would be acceptable, but not, you can't just say, I want some extra, like 20,000, 30,000, just to be sitting there. That's not going to work. That would not work. That would not be acceptable. You can always come back, or two options. You can always come back and get another loan, or potentially you could ask the lender. If you discover you have an additional need, you could ask the lender to increase the SBA loan. We do allow increases to existing SBA loans, so you could do that.
Good to know. Next question is, if I believe my business is ready for a microloan, what should be my first step after this webinar?
So first of all, I mentioned if you're in Virginia, I think most people on today are. The first thing I would do is check to see if there's a micro lender covering where your business is located. If there is not one, uh, and I can share this with Allie later. So I told you we have a couple of holes covering the whole state. There are some non-SBA options. There's a local CDFI here in Richmond. They, I think, lend anywhere in Virginia. And then there's also the Virginia Small Business Financing Authority, which is the state equivalent to us. They have their own micro lending program. I believe, though, that only goes up to 25. No, actually, they may have increased that. So I think it may actually go up to 100,000 now. But I will share that with Allie, and she can share that with you. But once you determine there is a lender there potentially could help you, you would, again, a lot of the information that we covered under the 7A program would also apply to the microloan program. So in terms of the documentation that the microlender is going to want to see, it would be similar. So you could use the slides that we had here today just to gather the information, and then you could reach out to the microlender and start the application process.
Thinking I'd just like to add to that answer, if you start looking into that information and find that it's a lot more than you were expected to handle, please do reach out to us at the Capital Pathways program. Our advisors can help you through that process. Next question, for a 100% US owned professional services firm offering communications work, Are SBA 7A working capital funds restricted to domestic payroll only, or can they be used to cover legitimate direct project costs for international independent consultants, provided the prime contract is with a U.S. entity?
So we didn't talk about this in this webinar, but we do have export lending programs, and we have a dedicated, they used to call them an export finance manager, but they've sort of changed that name a little. But so for instance, if you're providing a service, you're exporting a service, or in this case, it would be a service, not a product, you could get funding, an export loan to fund that need. I mean, generally, I could say we are, SBA loans are restricted to to U.S. for firms only located in the U.S. The programs we've been talking about today, yes, it would be for domestic payroll. But again, we have export lending programs potentially could be of use, and I can send that to Allie and she can share that. Or if you like, I could see if I can find a link, put that in the chat right now.
Thank you. Cord, are you good for the next question while you look that up?
While I'm looking that up, you can go on to the next question.
All right. Question asker runs a training and recruiting business. What type of SBA loan would you recommend to support them scaling the program and increasing student enrollment? And what would they need to qualify?
Okay, when I get these questions about the best loan program, I don't know that there is a best loan program. It depends more on what you'll use the funds for. So let's say in this case, you decide that a line of credit is something that you may have a need for. I mentioned earlier, we have the Express program, which for any request up to 500,000 is the best program to use. We do have some other, we have a working capital pilot program. We have another program dedicated to manufacturers, so those are available. But I would just discuss with the lender what program to use, and they can guide you on that. That's what I would say on that. I'm looking for the. I'm putting here the. So I'm going to put a link. I'm sorry. I'm going to put a link right now for I mentioned the export finance managers. Again, they don't really call themselves that anymore, but they're the ones that you could talk to about. And then I'll put a separate link for the export lending programs. Yeah.
Thank you. And just to add again onto that last question, feel free to reach out to me or our Capital Pathways team, and we can help you kind of narrow down what the different pieces and parts are that you would need to qualify for the different types of SBA loans, and help you get informed for when you go into those conversations with lenders. And I've added my contact information to the chat for everybody if they need it. Touching back on the question about gradual dispersal of the loan, the question asker wanted to clarify that they were thinking the lender would keep the money and disperse as needed. Is that an arrangement that you've seen before, Ford, or is it more, you apply for one loan and then use that up, and then you can extend that loan or expand that loan as needed?
Yeah, that's not what I was talking about before, where they were going to set a pot aside and only use it if they. So this is a good follow-up. So we definitely, SBA loans can definitely be used to offer multiple disbursements. So let's say we see that with construction, especially. We see that with lines of credit. Definitely, that's where you can draw and pay back, draw and pay back. But we allow the lender actually 48 months to fully disperse a loan. So you can have multiple disbursements, let's say you're applying for equipment plus working capital, plus some other things. Yes, the lender can disperse that over time. What I was getting at is just that you have to show a need for that within a reasonable amount of time, and not that you're just going to have that sitting aside there, sort of a just in case thing. But yes, lenders can offer multiple disbursements on 7A loans. Yeah.
Good to know. And I believe that was the last question that we have in the queue. So I'll give it a minute or two for folks to get in their final questions before we close out for today. Board, are there any other kind of frequently asked questions that you've come across or key things that you'd like people to take away from today's session?
Well, the key thing I would take away is, just as we said at the beginning, preparation is key. So I would definitely be sure that you are prepared. The way I describe this, and this is me personally, not SBA, I sort of describe this as you need to go into these situations as thinking like a lawyer. When a lawyer goes into court, they anticipate, they train themselves to anticipate questions that will be asked that might might stun them, or they might not have an answer to. So you need to sort of think like that. Think like a lender would and say, well, what would they ask me when I'm applying for a loan, and be prepared to answer that. Especially, I mentioned, if you're a startup focusing on your projections, the lender is going to want you to explain, how you came up with those projections, your assumptions, and then they may ask you for, well, why did you put this particular figure here, et cetera, and they're going to want to feel comfort that you understand those projections and can explain that to them. I wouldn't say don't go in, we're not here to try to scare you or anything, but just be prepared as much as you can to discuss your whole business and the financing that you're needing and things like that. Other than that, let's definitely take advantage of the SBDC network, Allie's group. They're great professionals that can help you with guidance. She outlined that at the very beginning before I even started. So I would definitely take advantage of that. And they can also review your business plan, your loan proposal. They can, and it's never a bad thing to have somebody else look at your plan before you approach a lender. I would definitely do that.
And those are some excellent takeaways. And since I'm not seeing any additional questions in the chat, oh, there's one, spoke too soon. Would SBA funding support adding an e-commerce component to my existing business?
Well, it's not ineligible. I would say there, as long as you can explain to the lender your thinking behind that, why you're adding that. And, many people don't want to go to a physical store anymore, I guess. So it's not a bad option. So just explain why you feel that's needed and how it's going to, help the business. It's eligible. So that would just be a discussion with the business.
Alrighty. We have another one come in. I previously had a lower credit score, but I'm actively improving it and plan to reach 750 plus. If I also invest my own capital, would I be a strong candidate for an SBA loan to open a daycare franchise? Or would my past credit history still be a concern?
So the first thing I would say there is, depending on how long ago that history, maybe some slow payments, things like that, depending on how long ago that happened, the lender is going to want you to explain that. And what I usually say is, I understand the thinking behind this, but it's not recommended. You might not want to talk about it, or you're embarrassed about it or something like that. the lender's going to find out anyway. They're going to pull your credit report, so it's just best to be upfront about it and just explain what happened. And if you've improved the score, definitely that's going to help you. The higher the score, the better, and also potentially they might be willing to charge you a lower interest rate if you have a higher score. But we are here. We don't An SBA guarantee cannot, mitigate all risk factors, but it sounds like, yes, if you improve the score, you explain what happened. I don't see that should be enough for the lender to understand, and it would again, we don't set a minimum score here at SBA, but the lender will set a minimum score. Each lender will set their own minimum score.
Well, since we are over time and have gone through our questions, I think we will close things out for the day. Thank you so much, Ford, for your time and the excellent information. Look forward to future sessions with you.
Okay, thank you very much.
Thank you. And thank you to all of our participants today for your excellent questions. I'll be sharing a recording of today's session and the slides, as well as the links and handouts that Ford mentioned in a follow-up email that will go out within about a week of today. And if anybody had questions that they were a little hesitant to ask, please do reach out to either myself via the email that I shared in the chat, or set up an appointment request through the Capital Pathways website, which I also shared the link to in our chat. We'll do our best to connect you to resources that can support your business needs. Thank you, everyone, and hope to see you all in future sessions.
Thanks, Allie. Thanks.